Okay, we're recording now. Let me share my screen on my tablet here. And I may as well. I was going to turn off the video, but I guess I can keep the video going. So chapter 5, accounting for merchandising operations. Excuse me. So merchandising, what is a merchandising company? You can think of them as a retailer. They buy finished products and then they sell them to the consumer. They do not manufacture the products. So in this chapter, we're talking about all of the accounting transactions are from the perspective of a merchandising company or a retailer. Manufacturers, they convert raw materials and components into finished products. Then they sell those finished products typically to a wholesaler. Wholesalers will buy the finished products in large volumes from manufacturers, and they sell the products in smaller quantities to retailers, to merchandisers. Merchandisers will buy the product from the wholesaler and then sell it to the general public. So that's how it fits here. We got the manufacturer, we got the middleman, we actually got two middle people. General public can't buy from the manufacturer. Wholesaler comes and buys from the manufacturer large quantities of the product. They sell the product in smaller quantities to the retailers, of course marking up the price, and the retailers mark up the price again and sell to the end consumer. All right. If you have any questions, let me know along as we go. So the operating cycle for a retailer, 3 primary steps. Retailer will purchase the merchandise, or you call it inventory. They'll purchase the inventory from the wholesaler. Then they'll turn around and sell their inventory to the consumer. And they'll have an account receivable with that consumer. And then the customer will pay off the account receivable, and the retailer will receive cash. So that's the operating cycle. Cash goes out to buy the inventory, and then cash comes in from the customer who bought the inventory from you. And that completes the operating cycle. For a service firm, they perform a service. There's no inventory. That's the difference. They just perform a service. There's an account receivable with the customer, and the customer pays off the account receivable. But in this chapter, we're talking about things from the perspective of not a service firm, but a retailer where they have inventory. So how do costs flow? For a retailer, how do costs flow through the inventory account? Is basically what they're getting at in this slide. So let's highlight this. If we look at the inventory T account, this is how costs flow through the T account. We start the year with some beginning balance, or we start the month, or at the start of the period, there's a beginning balance. So we begin the year with a certain amount of inventory. So all right, this is our inventory T account, right? This keeps track of the dollar value of our actual physical inventory. And then we have our actual physical storeroom where our inventory is, right? A lot of students get these two mixed up. This is the storeroom where say we're a bike retailer. We buy bikes from a wholesaler. We mark up the price and sell them to the customer. Our bikes are stored right here, our physical bikes. You know, I don't know how to draw a bike very well. Something like this. There are our bikes. And then here's our accounting, on our books, and our accounting books, and our records. We have a T account for our inventory. And this right here is the dollar value of those bikes that are sitting there at the beginning of the period, right? All right, during the period, we purchase some new bikes or some new inventory. So we purchased 2 new bikes in our store. There they are. Now we had 1 at the beginning, now we have 3. Now the dollar value of these 2 bikes, what we paid to purchase them, you debit the inventory T account. And you credit cash, supposing you paid cash. All right, the beginning inventory dollar value plus the cost of goods purchased equals the cost of goods available for sale. So the sum of these 2 items right here, these 2 added up, is known as the cost of goods that are available to be sold. How many goods does that represent? It represents 3. This bike, and this bike. These are the goods that we had available to sell during the period. And what did it cost us for those 3? The sum of these 2 numbers, right? From the cost of goods available for sale, we subtract the cost of goods sold. So some of the goods that are available for sale, we sell, and the cost that we originally paid for those bikes is called the cost of goods sold. So suppose we sell this bike right here. What did we originally pay for that bike? We credit that to the inventory account when we sell that bike. And we debit cost of goods sold expense. And then that leaves us with an ending balance in the inventory T account. So the dollar value right here represents what we originally paid for these 2 bikes, because these are the 2 bikes left in our storeroom at the end of the month or at the end of the year. We have a question. Let's take a look. Nicole asks, do you put the price you buy the inventory for or sell it for? In the inventory account, it's all about prices that you bought it for, not prices you sold it for. Nicole, hopefully that answers your question. So that's what we have going on here. All right, this slide just summarizes. There's a relationship here. If you want an equation here, beginning inventory plus purchases minus the cost of goods sold equals the ending inventory, right? This number plus this number minus this number equals this number is basically is the equation. All right, there are 2 types of inventory systems a merchandising firm can use. They can use either a perpetual inventory system or a periodic inventory system. GAAP allows the company to pick which type they want to use. With a perpetual inventory system, think of the word perpetual. What does it mean? It means you're always doing something. Whereas periodic, you do something, but you only do it, at the end of every period. Periodically, not always. What are you always doing in a perpetual system? You're always calculating the cost of merchandise sold every time you make a sale. Just as I showed here. Every time, say you sell this bike right here, as soon as you sell that bike, you go and look, all right, that bike you just sold, you go and find the invoice when you originally bought that bike, and you look at what you paid for that bike, and you record that as the cost of goods sold, with a debit to cost of goods sold expense and a credit to inventory. You do that right when you sell that bike, no matter when it happens during the period. So whenever you sell something, you go and record the cost of goods sold. That's a perpetual inventory system. Perpetual inventory system, since you're calculating the cost of goods sold every time you sell an item, your ending inventory balance, or your inventory balance at any moment in the inventory account, is up to date. It's accurate. This number right here is accurate always. Perpetual inventory system provides the greatest control over inventory, because you're better able to determine if some items of your inventory have been stolen, or if you have perishable inventory, like eggs, if they've spoiled and things of that nature. You're better able to determine if an item has been stolen if you're always computing the cost of goods sold when you sell an item. The periodic system is the alternative that the company could use. And this is where you don't make a journal entry. Every time you sell an item, you don't go and calculate the cost that you originally paid for that item and record the cost of goods sold every time you sell an item. You sell items throughout the period. You don't record anything. You record the sales revenue. You record that journal entry, but you don't record the reduction to inventory and the debit to cost of goods sold expense. You don't record that entry. You wait until the end of the period, and you make a physical count of your inventory at the end of the period. And based on that physical count, you'll know this number, and then you can back out this number. So what I've described here on your screen is the perpetual inventory system. What would the periodic inventory system be? Well, when we sold this bike number 1 here during the period, we would not make an entry. We would not make an entry. And then at the end of the period, we would just look in our storeroom. We would see there are 2 bikes there, and we would have an invoice for each of the bikes, right? When we originally purchased them, and we can see what we paid for each of those 2 bikes. Sum that up, sum the 2 bikes price that we originally paid, and then put that as our ending balance in inventory, because that's what it should be, right? This represents the dollar value of what's left in our storeroom. And then this is a plug, right? And we can just solve for it. This, which we have, plus this, which we have, minus this, which we don't know, has to equal this, and we can solve for this. That's what the periodic inventory system does. It backs out the cost of goods sold using this equation here at the end of the period. Periodic inventory system is not as good as a perpetual inventory system in some ways, right? For example, you won't know if an item has been stolen or if something has happened until the end of the period when you make that physical count, right? If something happens in one of these bikes, suppose during the period we sell bike 1, but bike 2 gets stolen, and then we look at the end of the period, there's only bike 3. We won't know that until we look at the end of the period. We won't know it. We would know that bike 2 got stolen, though, if we were using a perpetual inventory system. Because we'd notice, hey, our ending value and inventory account doesn't match up with what our storeroom says is in there. Because you know the ending value, that you know the balance and inventory account throughout the period at any moment if you're using a perpetual inventory system. So that's the downside of using the periodic over the perpetual. It's harder to keep track if something got stolen. But the upside, obviously, is you don't have to make a journal entry every time an item is sold. You don't have to make the cost of goods sold journal entry. You still make the sales revenue journal entry. You always have to make that, but you don't have to make the cost of goods sold journal entry. But another downside of the periodic system is at the end of every period, you have to literally go and physically count your inventory. And think about certain items, certain companies that have lots of inventory, right? What if Walmart uses a periodic inventory system? That would be unmanageable. At the end of every period, they'd have to literally go count physically every item of their inventory and all their shelves. That's not feasible. So Walmart uses the perpetual system. Every time they sell an item from the inventory, the cost of goods sold is booked. So most companies find that the costs of using a periodic inventory system over a perpetual inventory system, those outweigh the benefits. And so most companies use a perpetual inventory system. Do we have a, no questions, sorry. Which of the following best describes the flow of inventory costs? So you guys can answer this. In other words, which of the following best describes what happens in the inventory T account? This is what happens. So which of these lines up with that? Any takers? Nobody wants to answer? C, the cost of goods purchased plus beginning inventory should be equal to the cost of goods sold plus ending inventory. Let's see. Cost of goods purchased is here, plus the beginning inventory, should be equal to the cost of goods sold plus the ending inventory. Right, we can rearrange this equation. We can add COGS to both sides. Right, so that goes away. And over here, and so C is just describing this. Beginning inventory plus purchases equals ending inventory plus COGS. That's true, yes. So C is right. And keep in mind that these two things added together, we gave these another name, right? Their sum is called cost of goods available for sale. All right. For the rest of this, we're going to go through a numeric example to describe how merchandising firms account for purchases of merchandise when they buy inventory, and then how they account for sales of merchandise when they sell their inventory. So the actual journal entries. And we're going to be doing this from the perspective of a company, of a merchandising firm who's using the perpetual inventory system, not a periodic inventory system. In Appendix A of this chapter, they show you the periodic inventory system. I think they walk you through the same example in the PowerPoints, but assume the company's using the periodic inventory system. And you're responsible for that. We'll talk briefly about it at the end of the lecture today. It's so much, the periodic inventory system is easier. Perpetual inventory system is, there's more to think about. Well, when I say easier, the periodic system is easier in terms of from a journal entry standpoint. There are less journal entries because you don't make a journal entry for the cost of goods sold every time you sell an item. But it's harder in the sense that you got to go physically count your inventory at the end of every period, which is a huge chore if you have a lot of inventory. All right. So we have this company, Cali Company, however you pronounce that. And they purchased 200 cameras that they intend to sell, to resell to their customers. And they purchased the cameras for $42,000. What journal entry is required? And they're assuming that they purchased the cameras on credit. They didn't pay for them. So let's keep track of this stuff with a T account here. We'll keep track of things with the T accounts. The journal entries will be in the PowerPoint, so we won't need to write those down, but the T accounts, we can put these here to keep track. Let's just assume that the starting balance in inventory is 0. And they purchase 200 cameras for $42,000. on credit. They have to pay for them later. They haven't paid for them yet. So they would debit inventory for $42,000, and they would credit accounts payable for $42,000. We don't need to make a T account for accounts payable. I mean, we could, but we're focused in this chapter on the inventory account. All right, what does Kaylee do in regards to transportation costs? So Kaylee spends $42,000 to buy those 200 cameras. That's just what they paid for the cameras. What if Kaylee has to pay for the shipping on those cameras, which usually the buyer has to pay the shipping cost? Usually that's how it works. I mean, how many times have you bought something where you didn't have to pay shipping? Not too often, right? You usually when you buy something, you got to pay shipping. So if Kaylee has to also pay the shipping on the cameras, that shipping cost is added as part of the cost of inventory. So it's just you debit inventory and say they pay with cash, credit cash. If they paid shipping, they would make this journal entry. The shipping cost gets added to the asset. So inventory after this entry would have an additional $200 in it. So it would have $42,200. This much for the actual cameras and this much for shipping, if Kaylee pays the shipping cost. Now what the PowerPoints say here is they say, assume that the transportation costs were paid by the seller. Callie's the buyer. Assume that they were paid by the seller so that Callie didn't have to make that journal entry because they didn't pay the shipping. Excuse me. All right. You heard of sales returns and allowances already. We talked about that before, but now there are purchase returns and allowances. So from the seller, it's sales returns and allowances, but from the buyer standpoint, it's purchase returns and allowances. So Kaylee's the buyer in this case. They bought the cameras. Well, Kaylee's going to be both a buyer and a seller whenever they go and sell the cameras to the customer. So that's why we're using this example to show you purchases and sales. Purchase returns represent the return of merchandise. So the buyer returns some merchandise that they previously purchased that they didn't want. That's what purchase returns are. Purchase allowances represents a reduction in the purchase price that the buyer has to pay the seller. And it's often given to the buyer to induce the buyer to keep the merchandise that the buyer otherwise would return. So you buy something, so the difference between a purchase allowance and a purchase discount is a technical difference, because that sounds like a discount to me, right? Reduction in the purchase price. But that's what a purchase discount is, just a simple reduction in purchase price to get the buyer to buy the item. But not thinking that if you don't do that, the buyer would buy the item and then return it. But a purchase allowance is a reduction in the purchase price. The reason you're giving them a lower price is because you know if you didn't, they would buy the item at that higher price and then return it. So this purchase allowances, the implication is that the item you're selling them, that you're giving them an allowance on as a seller, this item has some defect to it. It's not as high quality. There's some defect, something wrong with it slightly, or it's slightly used. So a great example would be when you go to GameStop and instead of buying a brand new Xbox One, you buy a refurbished Xbox One. From GameStop's perspective, they're selling you an Xbox and they're giving you a reduction in the price. That's a sales allowance. But from your perspective, it's a purchase allowance. Because if you purchase the Xbox, the refurbished Xbox, at the brand new Xbox price, and then you found out it was refurbished, you would likely return it. And so because of that, you pay a little bit less. GameStop will let you pay a little bit less. So that's a purchase allowance. That's different than GameStop selling you a brand new Xbox at a discount. That's a purchase discount. Hopefully that makes sense. So let's assume that Kaylee decided to return 20 of the 200 cameras that they originally bought. And we have to figure out, it tells us here, how much did those 20 cameras originally cost Kaylee? Well, they originally bought 200 cameras for $42,000. So each camera must have cost them originally 210. Now they want to return 20 of those 200. What's their journal entry? Well, we no longer have to pay for those 20. Assuming we haven't paid for them yet, we no longer have to pay for them. So we can reduce our accounts payable and we can reduce our inventory.
If you had already paid for them, would it be cash that you'd be crediting?
If we had already paid for these.
Because you have to give back the cash to Callie.
No, Callie's the purchase, the original one who purchased it. So if we had already paid the seller and now we're returning 20 of them, we would debit cash. The seller would have to give us $20, the dollars back to us, the 4,200 back to us, and in exchange we give them back the 20 cameras. That's right. Is that what you mean?
Yeah, that is what I meant.
That's right.
Meaning.
So that's the journal entry. We talked about a purchase discount. It's just a simple reduction of the purchase price that the seller gives the buyer in order to increase sales. To increase sales of normal working products, not to increase sales of products that have some defect. That's a purchase allowance. So the credit period is the maximum time that the seller gives the buyer to pay for the item. And it's often stated in net terms. So in dash, and then how many ever days the seller is giving the buyer to pay them back. So 30-day terms would be stated as N/30. And these terms would appear on the invoice that the seller gives the buyer. A purchase discount may be given for faster payment. This is often stated as the discount amount and discount period. So, for example, a 2% discount, if paid in 10 days, would be stated as 2/10. So the full terms in this example would be, so you're a buyer, you buy some stuff, you buy the 200 cameras from the seller, and they ship you the cameras, and you receive the cameras in a box, and you also receive an invoice. And on the invoice, it has these terms: 2/10, 2/10, comma, N/30. And that means you, as the buyer, Callie, you have 30 days to pay off the total amount. Otherwise, they will turn you over to a collection agency, or they'll charge you an extra fee. Those terms would also be stated on the invoice. But if you pay within 10 days, you get a 2% discount. So assume Callie receives the terms 2/10, comma, N/30, or 2/10, N/30 if you want to say it that way. And they assume that they do pay within the 10-day discount period. So how much do they owe? I guess we do need to keep track of accounts payable. To make this make more sense. So originally we owed $42,000, but then we returned $4,200 worth of cameras because we returned 20 cameras. So as of now, we owe 42,000 minus 4,200, which is what? 42,000 minus 4,000, it would be 38,000. So it's 37,800. That's how much we owe. And our inventory account is sitting over here with 37,800. Put underline under a balance. Now assume we pay within the 10 days. So we owe 37,800, and that's what we have to pay if we pay between days 11 and 30 from now, right? If we wait longer than 10 days, but less than 30 days, or within 30 days, we got to pay 37,800. But if we pay within 10 days, and suppose we do, what's the journal entry for whenever we pay them? So we have to figure out what the discount would be. So we're going to get a 2% discount on what we owe them, and we owe them 37,800. So 2% times 37,800, the discount is, and it tells you that here, $756. That's the reduction of the amount we have to pay. That's the reduction that we don't have to pay them 37,800. We have to pay them 37,800 minus 756. All right, so what's the journal entry when we pay them? Well, we know we write the check for $37,044, and we're paying off an account payable that is worth $37,800. So we debit account payable for $37,800. We credit cash for the amount that we pay them, which is $37,044. We only have to pay them $37,044, only 98%, right, of what we owe them, because we get a 2% discount. And this 2% discount, we reduce inventory by the amount of a discount. So our account payable now has a balance of 0. And our inventory over here, we reduce inventory by the amount of the discount. It now has a balance of $37,044, which is exactly what we've paid for those 180 cameras that are sitting there in our inventory. And that's why we reduce inventory by the amount of the discount, because GAAP requires that your inventory account, the balance in it, if you use a perpetual inventory system, which is what they're using, the balance in the inventory account has to be exactly what you've paid in cash for the items that are in your inventory. How many items are in inventory at this moment in time? 180 cameras, right? We originally bought 200, we returned 20, we have 180. How much have we paid in cash for those 180? Well, we've paid this amount. So our balance in inventory has to be what we've paid, 37,044. And that's why we reduce inventory by the amount of the discount. Because if we didn't reduce inventory, the balance in the inventory account would be 37,800, which is not what we've paid, because we've only paid 37,044. So hopefully that makes sense. So that's the journal entry for paying within the discount period. All right. Question, or which one of these is true? The cost of inventory includes each of the following except let's have a look. A lot of people are saying B. It could include B, right? It did in this example because Kaylee, the buyer, didn't pay the shipping costs. But usually the buyer does pay the shipping costs. And when the buyer pays the shipping costs, the cost of inventory does include transportation costs, right? You have to debit inventory for the shipping costs, like we said. Usually the buyer does have to pay that. So the cost of inventory will include initial purchase costs. It will include transportation costs if the buyer has to pay it, which they usually do. And it will include purchase returns and allowances. So I believe the answer here is C. But let's, all right, yeah. So the answer, so it includes A through C, like I said, but it does not include, obviously, that. Sales returns and allowances. All right, somebody asked something in inventory on the last slide, be on the debit side. No, they shouldn't. Everything's right as we have it. When you pay within the discount period for items that you purchased previously, you're going to get a discount. The amount of the discount, you have to reduce inventory with a credit to inventory for the amount of the discount. And I explained why you have to do that. It's so that the balance in your inventory account, after doing it, which would be 37,044, that has to match what you've paid in cash for those cameras that are sitting there currently in your inventory. If we didn't credit inventory for 756 here, what would the balance be in inventory after paying for those cameras, after paying for the 180 cameras that are sitting in our inventory? The balance would be 37,800. Is that what we've paid in cash for those 180 cameras? No, we paid 37,044. GAAP requires the balance in inventory at any moment in time to be what you've paid in cash for the items that are physically sitting in your inventory at that moment in time, if the company's using a perpetual inventory system, which Cali is. Now now Cali is going to sell some of these 180 cameras that they have. They're going to become a seller. So we need to make some journal entries from Cali's perspective to account for their sales of their merchandise. So if you use a perpetual system, you have to make 2 journal entries whenever you sell an item, right? One entry is for the sales revenue, and the other one is to update the inventory account, right? Debit cost of goods sold expense, credit inventory. If you use a periodic inventory system, you only make 1 journal entry when you sell an item, just the sales revenue entry. All right, assume Cali Company sells on account so that Cali does not receive cash. They receive a promise from their customer that the customer is going to pay Cali in the future. We'll call that accounts receivable. So Cali sells on account 30 cameras for $500 each. So the 2 journal entries are, first, the sales revenue entry. How much revenue does Cali earn? Well, they earn 30 times 500, $15,000. So credit sales revenue for $15,000, and then debit accounts receivable for $15,000. Cali expects to receive that in the future from the customer. So that's an asset. The other journal entry that Cali has to make is the entry that recognizes cost of goods sold. So they have to figure out, what did we pay for these 30 cameras that we sold from our inventory? What did we originally pay for those 30 cameras? And that's what we're going to reduce inventory by. We're going to credit inventory. We're going to debit cost of goods sold expense for what we paid for those 30 cameras when we originally bought them. And this is an error right here where it says to record the sale of 30 cameras. This is the journal entry to record the sale of 30 cameras. This should say to record the cost of the goods, to record the cost of the 30 cameras that we sold. So we have to figure out now, these 30 cameras that we sold, what did it originally cost us to buy those cameras? Remember when we originally bought the 200 for $42,000? We paid $210 per camera. But then we did return 20, right? And so our inventory, we had 180, right? But then those 180, did we pay our full amount for those? Did we pay the $37,800? No. we paid for the discount period. We only actually paid $37.44 for the 180 that are sitting there. Correct? Correct. And then we sold 30 of these 180. So this is what we paid for those 30. $37.44 divided by 180. $205.80. So $205.80 times 30 cameras is $6,174. Credit inventory and debit cost of goods sold expense. So maybe I'll put B for balance. That's a balance. This is a balance. This is a balance. And then now our inventory account consists of, and here there were 180 cameras. Here there were 200 cameras. So this cost represents the 200. This is the cost for the 180. And then 37.44 minus 61.74 is 30,870. So now this is a balance, and this represents a balance on 150 cameras left, right? We have 150 cameras left in our storeroom, and what did we pay? What have we paid for those cameras? $30,870. Sales returns and allowances and discounts. This is where the seller, so when a buyer returns an item to the seller or takes advantage of a discount from the seller's journal entries for those transactions, they mirror the journal entries that the buyer makes, right? From the buyer, it's a purchase return or allowance or discount, and from the seller, it's a sales return, an allowance or discount. So here's an example. Suppose Callie had 5 cameras returned from the previous sale. So they sold 30, right? And suppose the customer returns 5 of them to Callie. We have to make 2 journal entries if we are a perpetual inventory company. If we're a periodic inventory company, we only have to make 1, right? These 2 journal entries undo a portion of the original journal entries that we made right here. So we had originally debited accounts receivable for the 30 cameras value and credited sales revenue for the 30 cameras, but now they're returning 5 of them. So we're going to credit accounts receivable for 5 cameras worth. They no longer owe us 5 times 500. They no longer owe us $2,500. They still owe us $500 for 25 cameras, but not $500 for the 5 that they returned. So we reduce accounts receivable by $2,500 with a credit. And you would think, oh, and then just debit sales revenue to reduce sales revenue for $2,500. But you don't do that. You debit the contra sales revenue account, which is called sales returns and allowances for $2,500. And that's this first entry here. Debit sales returns and allowances for $2,500. Credit accounts receivable for $2,500. All right, that's one journal entry. That kind of undoes the sales revenue, or a portion of it. But then the other journal entry we have to do is a journal entry that reflects the fact that we have 5 cameras back in our inventory now, right? So now instead of 150 in our inventory, we just got 5 returned to us. There's actually 155 now back. Right? So we have to undo these 5 cameras that we originally paid how much for? $205.80 are now returned to us. So we reduce our cost of goods sold because these cameras are no longer sold because they're now back to us. Reduce our cost of goods sold and increase our inventory by 5 times the 205.80, which is $1,029. So now the balance in the inventory account is, let's have a look, 3870 plus 1029. Now it's back up to 31899. And how many cameras are in our inventory that we could sell? 155 now, right? All right. You should know this already. We talked about this last time, and I told you last time that we would talk about it in greater detail in chapter 5, which is what we're doing. But net sales is just sales revenue minus sales returns and allowances minus sales discounts. Sales returns and allowances is a contra account to sales revenue. It has a normal debit balance because sales revenue has a normal credit balance. Same thing with sales discounts. So which of these things is not included in net sales? Which of these is not included in net sales? Right, right, Julia, thank you. The cost of the merchandise is not in net sales. Net sales is sales revenue. And what's in sales revenue? The cost of the merchandise or what you sold it for? What you sold it for, which is hopefully greater than the cost of the merchandise. Net sales is sales revenue minus sales returns minus sales discounts. Yeah, you're right, Nicole. Yeah, what's in sales returns and allowances? Whenever they return it to you, what do you do? Do you debit sales returns and allowances for the what you originally paid for the item that they returned to you, or for what you originally charged them for the item that they returned? For what you charged them, right? So the cost of the merchandise is not in any of these, is not in net sales. Define the gross profit percentage and the return on sales ratio and explain their use in profitability analysis. Actually, before we do that, I'm going to jump ahead to the appendix, Appendix A of chapter 5, and we're going to do the journal entry. We're going to do each of these journal entries, but from the perspective of Kaylee being a periodic inventory company instead of a perpetual inventory company. Whether you're periodic or perpetual, when you purchase inventory, you debit inventory and you credit either cash or accounts payable. Whether you're periodic or perpetual, doesn't matter. If you have to pay for the shipping costs, you debit inventory, credit cash, so that doesn't change. When you are a periodic company and you return 20 cameras that you originally bought, you don't make a journal entry. Only do that if you're a perpetual company. So no journal entry for the returning the cameras. If you're a periodic company, when you pay for the cameras, and suppose you pay within the discount period, you would make this entry right here. So periodic and perpetual, this entry would be the same. If you're a periodic company, when you sell inventory, you just make the first entry. You do not make the second entry. You don't recognize cost of goods sold each time you sell. If you're a periodic company and you return something that something is returned to you that you previously sold, you just make the first entry, not the second one. Because remember, the second one undoes the cost of goods sold entry you originally made, but you didn't make one. So there's no need to undo something you didn't do in the first place. So you would just make this first entry. You do have to undo, you do have to recognize the sales returns and allowances. This is what the appendix, chapter 5, appendix A goes through. It goes through the same example, but from a periodic standpoint. So I'm just talking you through it. So yeah, that was it basically. So what you would do if you were Cali, you would not have made this entry. You would have made the when you pay for the item and you take a discount, you do make that entry. You wouldn't have made these entries. So what you would do at the end of the period, I mean, you would have known this, you've known this, you know this. So from your standpoint, the balance is 37,044 on your books in the inventory T account. But you have to go and look in your storeroom and see, literally count your inventory. You would see there's 155 bikes sitting there at the end. You can literally count them. So this balance that's on your accounting books was represented a balance of there being 180 bikes there, but there's actually 155. So things have changed, right? You've sold some, and some that you sold were returned to you. And so you would just take this 155 and you would multiply the 155 by the 205.80 to get the ending balance. That would give you that number right there. And then what would you do? You would just make one entry in the T account for cost of goods sold. And it would be over here. You would make the entry, the plug. 37,044 minus X has to equal 31,899, solve for X. And that's what you would call a cost of goods sold. But that would be an overestimate of cost of goods sold, because remember, some of the items they actually returned to you and you had to reduce cost of goods sold whenever they return those to you. And this is why GAAP prefers companies to use the perpetual method. And that's why most companies use the perpetual method, because why would they want to overstate their cost of goods sold? That's just going to make their net income look lower than it really should be. Hopefully that makes sense to you. But this is what a periodic company does. Since they're not making an entry every time they sell an item, they just, at the very end, they look at their inventory, they count the number of items, they know what they originally paid for those 155, they multiply the original cost by the 155, get the ending balance, and then the cost of goods sold is just the plug. And if there are items that were returned to the company that they sold this period, items that they sold that were returned to them, then the amount that they compute as cost of goods sold is going to be an overestimate, because they should have also put some amount over here as well whenever the people return the stuff. So gross profit percentage. It's calculated as gross profit divided by net sales. It's a key metric followed by analysts, and it's just a metric that indicates a company's ability to sell its products at acceptable prices. So in our example, the gross profit percentage for Cali Company for the month of December, so all this stuff that we were told about in this example happened in December. Their sales were $15,000, right? They sold 30 cameras. But the sales returns and allowances were $2,500, so we have to subtract that, right? If there were any sales discounts that they offered to their customers, they would have to subtract those. It didn't tell us about any. So sales minus sales returns and allowances is equal to the net sales, in this case, 12,500. And the cost, what it originally cost them for those 25 cameras that they sold. They sold 25, right? They sold 30, but then 5 were returned. So those 25 that they originally sold, what did it cost them? It was the 25 times the 205.80, which is the $5,145. That gives us our gross profit. And we just take our gross profit and we divide it by our net sales, and that gives us our gross profit percentage. After multiplying by 100. I mean, this number is 0.588 times 100, 58.8%. You want your gross profit percentage to be as high as possible. Obviously, it cannot be more than 1, right? Gross profit can't be greater than net sales. The maximum gross profit would be net sales, and that's only if cost of goods sold is 0, which is not likely. And then we have our return on sales ratio, which I believe we already taught you. It's just net income divided by net sales. So the return on sales ratio will be smaller than the gross profit percentage, because after gross profit, we subtract some other expenses, right? We subtract the operating expenses and we subtract any other things and income tax. And that gets us our net income. So our net income is always going to be smaller than our gross profit. So when we take net income divided by the same denominator, divided by net sales, we're going to get a smaller ratio than if we take gross profit divided by net sales. Both of these are measures of a firm's ability to sell their products at good prices, their ability to make money, their profitability. Gross profit percentage and the return on sales ratio. Maybe I should write return on sales is always less than the gross profit percentage. Because both of these ratios have the same denominator, but this one has a smaller numerator. So the ratio will always be less. Here's a quick check. Castle Company reports net income of $100, net sales of $1,000, and their cost of goods sold were $600. Which of the following is true of Castle? Anyone? B is correct, Julia. Return on sales is net income 100 divided by net sales of 1,000. So that's 10%. So we know it's between A and B because they both have 10% for return on sales. And now to delineate between A and B, we have to go look at the gross profit percentage. Gross profit percentage is gross profit divided by net sales. Gross profit is net sales, 1,000, minus cost of goods sold, 600 or $400. So $400 divided by the net sales of 1,000 is a 40%, not the 60%. So B is correct. Good. The Appendix A, it just illustrates, gives you the journal entries from the perspective of the company using a periodic inventory system. Most companies don't use a periodic inventory system. Most companies use a perpetual inventory system for many reasons. We talked about them. But you're responsible for knowing the journal entries if a company uses a periodic inventory system. So have a look at that appendix. And I went through them. I talked through them. I didn't actually write them down, but I talked through the differences. I went through each journal entry that we made in the Cali company example. Cali was using a perpetual inventory system. And I said what they would do if they were using a periodic inventory system. So all the journal entries that you have to make if you use a perpetual inventory system. No. Yeah. There's more entries with the perpetual inventory system. For some of the entries, if you use a periodic system, you just don't have to do that entry. Basically, that's how it is. And you just have to know which entries you don't have to do. And then at the very end of the period, the company using the periodic system, they make that one entry for cost of goods sold. And the amount that they put for cost of goods sold could be different than the amount that the Perpetual inventory company would have, in the aggregate, computed for cost of goods sold. And these two amounts would differ if the company had sold something that was returned to the company. That's where they would differ. If the company sold something and it was nothing was ever returned to them that they sold, then both systems would compute the same cost of goods sold. Adam asks, was there a net sales equation? Oh, yes, there is a net sales equation. This was on the last exam. Net sales revenue equals sales revenue minus the balance in the sales returns and allowances account The sales returns and allowances account is a contra account to sales revenue. Normal debit balance, normal credit balance. And then we also have to subtract the balance in the sales discounts account. Sales discounts is also a contra account to sales revenue and has a normal debit balance. Quick summary, whenever you sold an item to a customer, you would credit sales revenue, right? And if they didn't pay you yet, you would debit accounts receivable. And then suppose they return an item to you. Say you sold 3 items to them and they return 1 of them. Then you would think, oh, I would just debit sales revenue to undo the sales revenue. You don't debit sales revenue. You debit sales returns and allowances for the dollar value of what they returned. You know, what you originally charged them for that item, you have to debit sales returns and allowances because they no longer have to pay you that, and you don't recognize that as revenue because they returned it to you. Yeah, this is it, Adam. All right, that's pretty much, I think that's all the PowerPoints, isn't it? You're welcome, Adam. Corporate social responsibility. Oh, appendix, there's an appendix 5B. Let's look through this. Let's see if you need to know this. I'm not sure if you do or not. You don't have to know this for the exam. But the idea is, all right. Instead of, whenever you sell an item to a customer, or say you sell 10 items, before GAAP changed slightly, the way you would journalize it is you would just credit sales revenue for the dollar value of what you sold them, right? Debit, say they paid you cash, debit cash. Oops, get rid of this. Debit cash and credit sales revenue. And then you just wait. And if they return something to you, then you debit sales returns and allowances. And then, of course, if they had paid you, you got to pay them back. So credit cash, give them their cash back. But GAAP changed slightly, and what they say is that you should, when you originally sell the 10 to them, the 10 items, you should kind of make an estimate. How much do you think they're going to return to you? And you record the revenue you record. So if you expect that they're going to return, 2 of them of the 10, you don't book sales revenue for 10, you book sales revenue for 8. And then at the end of the period, if they didn't return 2, right? They kept the 2, so they have all 10. Now you got to go and book sales revenue again for the additional 2 because you originally only booked it for 8. Or if they return 3 instead of 2, so you were off in the other way, then you got to go debit sales returns and allowances. So that's what this appendix is talking about. Hopefully that makes sense. So you estimate what you think they're going to return, and that's what you book revenue for. And then at the end of the period, you go and adjust it based on what actually happened versus as relative to your estimate. And the reason GAAP changed the standard is because with this, it things are more in advance. In advance, you can have an idea of what's going to happen more in advance, you know, instead of just waiting. Like if you have a history, and the reason some companies have this history, they know that on average 20% of things they sell are returned. There are a lot of industries where companies sell goods, and that's the case, where 20% of things are returned, you know, especially online clothing. You know, stuff doesn't fit, doesn't look good on you. You thought it looked good on the website, you return it. And so these companies, Gap made this standard just for these types of businesses. They should estimate, you know, that way things are more in line with what's going to happen in the future. Hopefully that makes sense. And I don't think you need to know this for the exam. I'm just looking here. And if you do have to know it, I can't remember exactly if I want you to know this. I don't think you do. I don't think I'm going to have you know this. But if for some reason you do, I'll go over this carefully next time. But for now, you don't worry about Appendix 5B. The reason I was talking about it a little bit is because for the homework, there may be a question on it where you need to know, you have to go look at Appendix 5B to see how to answer the homework question. But for the exam, don't worry about that. Let's see, do we have a question? No more questions, all right. All right, so that's all I have. That's all I have for today. Are there any further questions? You guys just need to read the chapter, you know, go do the examples that are in the book, in the chapter. Make sure you understand the examples they're doing. I mean, that's how I would study. Then, of course, once you've read the chapter and you kind of understand what's going on, then try to work some practice problems. Of course, that comes next. But that's how to do well in the class. You got to stay up with the material, read the chapters. I'm walking you through it, but there's no substitute for you getting in there, and you're going to learn it best that way. Now you'll have this YouTube, I'll upload this to YouTube, and you'll have this to go back and listen to, and especially some of the key things that I say. Often it's what I say, not what I write, that's key to understanding the problem. But while you have that, you can go back to YouTube and listen to it. I know you have other classes, and the videos are longer. They take a long time to watch, but you do have that available to you. You can play me back at 150, you know, speed. You can play me at 75% speed if I'm too fast. You can slow me down, speed me up. That's the beauty of uploading things to YouTube, and you guys can watch it at your own convenience. If there aren't any questions, have a great day, and I'll see you guys on Thursday. We'll work problems. You're welcome. Take care.